A lot of news on interest rates, y'all. Very good news for interest rates today. Not great news for the job market. So we're going to dive in and talk about what's moving it all in today's video. Glad to have you with us. Today is the 5th of September, Friday. This is Jobs Day. This is the BLS jobs report that comes out on the first Friday of every month. This has been the largest market mover, even eclipsing inflationary news, y'all, at least this year, because these reports have been so inaccurate over time that we're finally starting to get a real read. They're finally starting to reflect some reality, likely due to the fact that we've had a change of leadership there that is more focused on getting accurate numbers. Here's what we got, y'all, and I'm sure the administration is not going to be happy with where these numbers are coming out, but we can have a little more confidence because these numbers are starting to mirror numerous other avenues where we measure strength in the jobs market. There's been a big disconnect between the BLS numbers and other data. They are now starting to marry up, and we're starting to get a better sense of the labor market, y'all, and it's weaker than expected. Up 22,000 new jobs is what we got reported for last month. 75,000 jobs were predicted to be created in August, y'all. So that was a big miss to the downside. The prior 2 months, June and July, were also revised lower by 22,000 jobs. In fact, when you look at June, June was revised to a negative number. That is the first time we have lost jobs, lost net jobs in any reporting month going back 54 months. That's 4.5 years, y'all, since we've had a negative report, and that was on the heels of COVID. So the predictions are the Fed will be absolutely cutting. In fact, when you look at the CME FedWatch tool, Fed futures now have a 100% chance of a quarter-point move at the meeting upcoming on the 17th of this month. Here's the thing, though, y'all. If the Fed moves a quarter, we're going to see rates go up on the 18th. And here's why. There's a 12% chance of the Fed moving a half a point at that 9/17 meeting. So if the Fed only gives us the quarter, there's a monetary value to that 12% of Fed funds futures trading that is affecting monetarily the value of fixed income securities that are impacted by Fed policy. So in that eventuality, if the Fed gives us a quarter, then that 12% chance of them going a half immediately gets priced out. So we will actually see a bit of a bump higher in rates after the meeting. This is a challenging thing to explain to folks, y'all. We are now, according to Mortgage News Daily, so let's dive right into the numbers, and I think it'll become a little more clear as to why rates with a quarter point cut by the Fed on the 17th will actually go a little bit higher. It's already in current pricing, y'all. As soon as this report came out, we dropped a quarter of a point this week in anticipation of a weak jobs number. And now the reality of it, we are sitting right now, national survey, 30-year fixed rate, according to Mortgage News Daily, 6.29%. You have to go back to the 3rd of October to find better pricing than that, y'all. We were at 6.50% a week ago, so we're down a quarter this week, which is pretty dramatic. Most of that was today, y'all. In fact, the lion's share of it was today. We were at 6.58% 1 month ago. So in other words, interest rates immediately went down with this weak jobs number today in anticipation of what the Fed's going to do at their next meeting. If the Fed simply does that, we're not going to see much of a change. And in fact, that bit of a premium that's in there for looking for a half point cut, if we don't get that, we'll immediately get priced out and we'll see rates go a little bit higher. Hope that makes sense. Don't wait for this upcoming report and think that just because the Fed cuts that we're going to see better pricing. We likely won't. In fact, in the near term, we'll probably see pricing a little bit higher, at least until we get the minutes of this meeting, and those don't come out until the 9th of October. Y'all, so we've got 3 weeks or so that we have to wait to see what each Fed member is thinking when those minutes are released on the 9th of October. That will give us more insight about how aggressive they're planning to be going forward. And really, the market's going to be data driven until then. Let's talk about data for a minute because we got a lot of that coming up. Producer price index on Wednesday of next week could be a market mover. CPI on Thursday of next week could also be a market mover. If we see real strong numbers, and meaning a flare-up in inflation in an unexpected way in either of those reports, that's going to take some of the benefit that the bond market is reaping from this weak jobs market out of pricing. I was advising folks, anytime we see the kind of improvement we saw this last week, don't float going into these impactful reports. If you have a loan to lock, get it locked and benefit from whatever improvement you've seen that week because it may not be worth the risk. Every lender has some form of a rate renegotiation. If rates go dramatically lower, they're going to help you get back to the market rate. They don't want to lose you out of a locked pipeline because rates have gone up, and we're like every other lender in that regard. We protect our borrowers. We don't want to see them hurt by movements in the bond market. So if we see a dramatic benefit prior to closing, every lender out there has got a way to help accommodate a borrower in that regard. Here's the thing, y'all. We're going to see the Fed move a quarter at this next meeting. It's going to help between now and then interest rate wise. We may well, based on where pricing is today, see better pricing on Monday. But then we're going to immediately start pricing in risk for that PPI report on Wednesday and the CPI report on Thursday. And you'll see rates probably trending higher going into those two reports. In any event, it's a mixed bag. It's an exciting time for nerds like me that geek out on numbers like this. So hopefully this is helpful for you and for your clients. Let me bottom line it for everybody. If you are considering purchasing a home, do not wait. This is your Goldilocks moment. This benefit in pricing is here already. It's not waiting for the Fed to actually meet and cut rates. It's already in current pricing. Take advantage of it before the announcement from the Fed that tells the whole world that rates are starting to trend lower again, in which case they're all going to start trying to find a home and you're going to be competing with them. And y'all, as we said last week, the concessions that are in the marketplace right now immediately go away when the Fed moves to a more accommodative position. In any event, I hope this is helpful for you and for your clients. Stay safe, stay blessed, we'll stay on top of it, and we'll talk to you next week.